Hello, my commerce buddies. How are you? I hope you all are doing great. My name is Shivam Mantri, and I welcome you all in my YouTube channel, that is PSU Finance Jobs. Through this channel, my effort is to provide you with the content related to the finance jobs that comes in PSUs and government departments, right? From the previous video, we have started our discussion for the account subject that comes under technical portion, right? And to be specific, we have started with accounting standards, and we have already discussed accounting standard 1 and accounting standard 2, right? So if you haven't watched that video, I suggest you to watch that video and then continue with this video. And from today's video, we will discuss accounting standard 3 and onwards, right? So without any further delay, let's jump right into it. So AS3, accounting standard 3, cash flow statements. For companies, as per Companies Act 2013, cash flow statement is required to be prepared by every company except OPC, that is one person company, small company, and dormant company. So one person company, small company, and dormant company are not required to prepare cash flow statement. For non-companies, AS3 is non-mandatory for entities falling in level 2 and level 3. In the previous video, we have already discussed that some of the AS are not applicable to level 2 and level 3. So AS3 is one of them, right? Now, this standards deals with the provision of information about the historical changes in cash and cash equivalents of an enterprise by means of cash flow statement. So MCQ can be framed like this: which standard deals with the provisions of information about historical changes in cash and cash equivalents? So correct option will be AS3, cash flow statement. Cash flow statement classifies cash flows into three activities, that is operating, investing, and financing activities, right? Cash comprises cash on hand and demand deposits with banks. So cash includes cash in hand as well as demand deposits with the banks. What is cash equivalents? Cash equivalents are short-term, highly liquid investment that are readily convertible into known amounts of cash and which are subject to an insignificant risk of changes in value. So cash equivalents are what? Highly liquid investment, short-term investment, right? An investment normally qualifies as cash equivalent only when it has short maturity. So only if an investment is of short maturity will fall under the category of cash equivalents. So short maturity will be like 3 months or less than 3 months, right? Presentation of cash flow statement. The cash flow statement should report cash flows during the period classified by operating activities, investing activities, and financing activities. Operating activities are principal revenue producing activities and other activities that are not investing or financing activities. Clear? Principal revenue producing activities are operating activities. And what are investing activities? Investing activities relate to acquisition and disposal of long-term assets and other investments not included in cash equivalent. So any activity which relates to acquisition and disposal of long-term assets will fall under investing activities. Now moving on, financing activities that result in changes in size and composition of owners capital, right? Equity, borrowings, etc. So any activity which changes the size and composition of owners capital will fall under the category of financing activities. So moving on, cash flow statement. AS3 prescribes two methods for preparing cash flow statement. These are direct method and indirect method. So under direct method, major classes of gross cash receipts and payments in respect of operating activities are presented. And under indirect method, net profit or loss is adjusted for effects of transactions of non-cash nature, deferrals or accruals of past or future operating cash receipts or payments, and income and expenses items associated with investing or financing cash flows. Moving on, reporting of foreign currency cash flows. So cash flows arising from transactions in foreign currency, and other is effects of changes in exchange rate on cash and cash equivalents held in a foreign currency. So first look at cash flows arising from transactions in a foreign currency. So AS3 says that any cash flows arising from transactions in a foreign currency to be recorded in the reporting currency of the enterprise using the exchange rate on the date of cash flow. And effects of changes in exchange rates on cash and cash equivalents held in foreign currency to be reported as separate part of the reconciliation of the changes in cash and cash equivalents during the period. So here's example of classification of interest and dividends. So interest and dividends for non-financial enterprises. Interest paid will fall under financing activities. Interest received will fall under investing activities. Dividend paid will fall under financing activities, and dividend received will fall under investing activities. So again, repeating this example, uh, non for non-financial enterprises any enterprise other than banks or financial institutions. So any normal enterprises for any normal enterprises, interest paid will fall under financing activities, interest received will fall under investing activities, dividend paid will fall under financing activities, and dividend received will fall under investing activities. So again, this is very important for MCQ point of view. You should remember these examples, right? And for financial enterprises like banks and other financial institutions, for them interest paid will be operating activities because their main business is of lending and receiving money. So for them interest paid will be under operating activities because bank pays interest to the customers for saving accounts and FDs like that. So for them interest paid will be under operating activities. Like that, interest received will also fall under operating activities. Banks charges interest for loan given, so for them the interest received will fall under operating activities. Dividend paid will fall under financing activities, and dividend received will fall under operating activities. Clear? Now moving on. Taxes on income. Cash flows arising from taxes on income should be separately disclosed and should be classified as cash flow from operating activities. So taxes on income will fall under cash flows from operating activities. Non-cash transactions, investing and financing transactions that do not require the use of cash or cash equivalents should be excluded from cash flow statement. That was cash flow statement AS3. Now moving on, AS4. AS4, contingencies and events occurring after the balance sheet date. This standard deals with the treatment of contingencies and events occurring after the balance sheet date. A contingency is a condition or situation that the ultimate outcome of which gain or loss will be known or determined only on the occurrence or non-occurrence of one or more uncertain future events. So again, it is very important for the MCQ point of view. You should know the definition of a contingency. So a contingency is a situation or condition the ultimate outcome of which gain or loss will be known or determined only on the occurrence or non-occurrence of one or more uncertain future events. Events occurring after the balance sheet date are those significant events, both favorable and unfavorable, that occur between the balance sheet date and the date on which the financial statements are approved by the board of directors in case of a company, and by the corresponding approving authority in case of any other entity. So events after balance sheet date are those significant events that that occurs between the balance sheet date and the date of finalization of accounts by the board of directors. Clear? Now AS4 says that there are two types of events. One is adjusting event and second is non-adjusting event. So adjusting events, meaning adjusting events are those events which provide further evidence of condition that existed at the balance sheet date. These are nothing but those events that provide further evidence of conditions that already existed at the balance sheet date, right? And non-adjusting event, those which are indicative of conditions that arose subsequent to the balance sheet date. So any kind of event that occurs after the balance sheet date which has no relation with the period of balance sheet date, or which does not provide any further evidence of conditions that already existed at the balance sheet date, will fall under the category of non-adjusting events. Clear? Moving on, accounting treatment for contingencies. Contingent gains should be recorded in the financial statements. Contingent loss should be provided for by charge in the statement of profit and loss if it is probable that future events will confirm that after taking into account any related probable recovery, and an asset has been impaired or a liability has been incurred as at the balance sheet date, and a reasonable estimate of the amount of resulting loss can be made. If neither of the above conditions is not met, the existence of contingent loss should be disclosed in the financial statement. So, uh, contingent loss should be charged to profit and loss only if two conditions are met. First is if it is probable that future events will confirm that, and second, a reasonable estimate of the amount of resulting loss can be made. If both these conditions are not met, then only the contingent loss should be disclosed in the financial statement. Moving on, events occurring after the balance sheet date. Adjusting events we have already discussed. Again, we are seeing this. Adjusting events, assets and liabilities should be adjusted for events occurring after the balance sheet date that provide additional evidence to assist the estimation of amounts relating to conditions existing at the balance sheet date, or that indicate that the fundamental accounting assumptions of going concern is not appropriate. And non-adjusting events, for non-adjusting events, only disclosure should be made in the report of the approving authority of those events occurring after the balance sheet date that represent material change and commitments affecting the financial position of the enterprise. For example, example of non-financial event will be like uh, loss by fire, right, or loss by theft, or flood, natural calamities, right? So the if these events occur after the balance sheet date and the amount of loss is very huge, is material, so disclosure should be made uh, uh, in the report of approving authority, right? And these are non-adjusting events, so the the financial statement will not be modified or will not be adjusted for these kind of events, because they have occurred after the balance sheet date, and they do not provide any additional evidence regarding the condition existing at the balance sheet date. Clear? Proposed dividend. If dividend is declared after the balance sheet date, such dividends will not be recognized as liability at the balance sheet date unless a statute requires otherwise. Such dividends should be disclosed in the notes. So, for proposed dividend, it is a very simple concept. Dividend is declared after the balance sheet date. Such dividend will not be recognized as liability at the balance sheet date. Right? They will be shown as an disclosure only in the notes. So that was AS4. Now moving on to the AS5, that is net profit or loss for the period, prior period items, and changes in accounting policies. This standard should be applied by an enterprise in presenting profit or loss from ordinary activities, extraordinary items, and prior period items in the statement of profit and loss, in accounting for changes in accounting estimates, and in disclosure of changes in accounting policies. So, meaning of ordinary activities. Ordinary activities are any activities which are undertaken by an enterprise as a part of its business, and such related activities in which the enterprise engages in furtherance of, incidental to, or arising from these activities. So these are just normal activities that business undertakes usually. So these will fall under ordinary activities. Extraordinary items are income or expenses that arise from events or transactions that are clearly distinct from the ordinary activities of the enterprise, and therefore are not expected to reoccur frequently or regularly. So any activities which do not expected to reoccur frequently or regularly will fall under the category of extraordinary items. Prior period items. Prior period items are income or expenses which arise in the current period as a result of errors or omissions in the preparation of financial statements of one or more prior periods. So any error or omissions of previous period financial statements will be called as prior period items, right? Net profit or loss for the period. All items of income and expenses which are recognized in a period should be included in the determination of net profit or loss for the period unless an accounting standard requires or permits otherwise. The net profit or loss for the period comprises the following components, each of which should be disclosed on the face of the statement of profit and loss: profit or loss from ordinary activities and extraordinary items. Extraordinary items should be disclosed in the statement of profit and loss as a part of net profit or loss for the period. So, uh, again, for MCQ, it is very important. Extraordinary items should be disclosed in the statement of profit and loss as a part of net profit or loss for the period. So, it can be asked like this. So, what should be the treatment of extraordinary items as per AS5. So if the option says, if one of the options says that that extraordinary item should be disclosed in the statement of profit and loss as a part of net profit or loss for the period, so that option will be the correct option. Moving on, profit or loss from ordinary activities. When items of income and expenses within profit or loss from ordinary activities are of such size, nature, or incidence that disclosure is relevant to explain the performance of the enterprise for the period, the nature and amount of such enterprise should be such item should be disclosed separately. So any material items should be disclosed separately. Prior period items. The nature and amount of prior period items should be separately disclosed in the statement of profit and loss in a manner that their impact on the current period profit or loss can be perceived. So for prior period items, the nature and amounts of prior period items should be separately disclosed. Changes in accounting policy. A change in accounting policy should be made only if the adoption of a different accounting policy is required by the statute, or for the compliance with an accounting standard, or if it is considered that the change would result in more appropriate presentation of the financial statements of the enterprise. So two conditions in which you can change the accounting policy. First, if uh, there is different accounting policy is required by the statute or compliance with any accounting standard, and second one is if the entity thinks that the change in accounting policy would result in better presentation or more appropriate presentation of financial statement, then they should change the accounting policy. Changes in accounting estimates. The effects of change in accounting estimate should be included in the determination of net profit or loss in the period of change if the change affects the period only, that is current period. If the change in accounting estimate affects the current period only, then they should be included in the current period profit or loss, right? But if the change in accounting estimate uh, affects both current period as well as future periods, then such effect in accounting estimate should be included in the determination of profit and loss in the period of change, that is current period, as well as the future periods, right? The nature and amount of change in accounting estimate which has material effect in the current period or which is expected to have material effect in subsequent periods should be disclosed. So if the change is material for the current period as well as the future periods, then the nature and amount of such change should be disclosed. If it is impracticable to quantify the amount, the fact should be disclosed that the amount is the estimation of amount is impracticable. Right? Whenever it is difficult to distinguish between a change in accounting policy and change in accounting estimate, the change is treated as a change in accounting estimate. Very important for MCQ point of view. When it is difficult to distinguish between change in accounting policy and change in accounting estimate, the change is treated as what? A change in accounting estimate. So far we have discussed AS3, AS4 and AS5. Now let's just end today's discussion here only. From the next video onwards, we will discuss AS7, AS9 and rest of the accounting standards, right? So thank you guys for being a part of this discussion. If you have liked my effort, then please give me a thumbs up and share with your friends, and also subscribe to my channel if you haven't already done yet. Right? I see you in the next video. Till then, you take good care of yourself. Goodbye. Jai Hind.